Welcome to Talk Tickers. We cut through the noise of earnings calls to give you the essential insights.
And today, we're diving into the latest results from a major player.
Yeah, and the headline is, well, it's a bit of a mixed bag, isn't it?
Definitely. You've got this record backlog, which signals really strong future demand. That's the good news.
But there's always a but.
But yeah, some pretty significant financial adjustments, especially concerning the B-21 program. It's making the immediate outlook feel a bit cautious.
Okay, so let's unpack what you really need to know. Where do we start? The top line.
Let's start there. So first quarter sales landed at $9.5 billion.
Okay.
Which is actually a 7% decrease compared to last year.
7% down. Why is that? Just market conditions?
Not entirely. A few factors were at play. They actually had 2 fewer working days in the quarter this year compared to last.
Okay, that makes a difference.
It does. Plus, there were some delays in getting certain contracts finalized and just the timing of when materials actually showed up.
Right, supply chain stuff still lingering sometimes.
Exactly. But honestly, the biggest single impact, the one really moving the needle, was a specific adjustment tied to the B-21 bomber program.
The B-21, we'll definitely need to dig into that. But first, you mentioned a record backlog despite the sales dip.
Absolutely. That's the counterpoint here. The company is sitting on a massive $92.8 billion backlog of orders. It's a record for them.
$92.8 billion.
Wow. And what's really interesting is the strength they're seeing in international bookings. Demand outside the U.S. looks really strong.
So global demand is picking up.
Seems that way. And looking ahead, while they did update their 2025 financial targets, specifically because of that B-21 adjustment, their overall sales outlook for the year, that's still holding steady. They reaffirmed the range, $42 billion to $42.5 billion.
That's cash flow.
Same story there. Free cash flow guidance reaffirmed at $2.85 billion to $3.25 billion.
So the core business, ex B-21 weirdness, is basically expected to perform as they thought.
That seems to be the message, yeah. That's the key takeaway, I think.
Okay. What about profitability then, that operating margin?
Right. So the Q1 segment operating margin rate came in at 6%.
6%. That sounds, well, not great on the surface.
It doesn't. You're right. But again, you have to understand how much that B-21 adjustment is weighing it down.
Heavily influenced, you mean?
Massively. If you mentally pull that adjustment out, their operating income would have been pretty much consistent with Q1 of 2024.
Okay, that provides important context. And earnings per share followed a similar pattern.
Exactly. EPS was lower, number one reason, that B-21 adjustment. Again, it hit them for about $2.74 per share after tax.
Ouch.
Yeah. And then you also had the effect of the lower sales volume we talked about, plus some higher corporate unallocated expenses factoring in.
Got it. And cash flow, always crucial. How did that look in Q1?
Well, Q1 saw an operating cash outflow of $1.5 billion.
Outflow.
Yeah, but there's important context here. This is actually pretty typical for their seasonal patterns. Q1 is often the use of cash.
Okay, so not necessarily alarming on its own.
Not necessarily. They fully expect cash flow to ramp up throughout the year. The biggest generation is usually weighted towards the back end, especially Q4.
Makes sense. And what about capital management? Debt? Shareholder returns?
They were active there. Repaid $1.5 billion of notes back in January.
Okay, paying down debt.
Yep. And returned nearly $800 million to shareholders through both dividends and share repurchases.
All right, let's circle back and dig deeper into that B-21 program. You said a significant adjustment. What exactly happened?
So they formally recognized an additional $477 million pre-tax loss in the first quarter, specifically tied to the B-21.
Almost $500 million. Wow, what drove that?
Primarily 2 things. First, higher manufacturing costs. This was linked to a change they made in their production process.
A process change. Midstream. Why?
Well, the stated goal is actually positive long-term. They changed the process, working with the Air Force, to enable higher production rates down the road.
So investing now for faster output later.
That's the idea. And the second driver was an increase in their projected material costs. Some of that is just broader macroeconomic inflation hitting everyone.
Right, materials are getting pricier everywhere. So this process change sounds like a big deal. Was it a surprise?
They presented it as a joint decision with the Air Force.
Yeah.
The aim is really to de-risk the scaling up phase, as they move towards the full program of record production rate.
And maybe even go beyond that.
Potentially. It could allow for a ramp up beyond the initial plans if needed. They stress that the learning curve from this specific change is now understood.
Meaning they don't expect this type of cost hit to repeat.
Exactly. That's the message. And importantly, while this $477 million charge hits the Q1 P&L.
The profit and loss statement, yeah.
Right. The actual cash impact, when the money goes out the door, that's going to be spread out over several years, mostly 2026, 2027, and 2028.
So not a big hit to this year's cash flow, 2025.
Correct. No material impact expected on 2025 cash flow from this charge.
And they still think the later B-21s, the non-test ones, will be profitable.
Yes. They reiterated their expectation that the aircraft beyond the initial low-rate production lots, the non-LRIP ones, will be profitable. And they also mentioned they're actively working to mitigate those inflationary pressures on materials.
Okay, so it's a short-term financial pain, it seems, for potential longer-term production gains and clarity on the B-21. Let's shift gears. What about the other parts of the business, defense systems?
Defense systems actually had a pretty solid quarter. Sales were up by $68 million. It's about 4%.
What drove that growth?
Mainly the ramp-up of the Sentinel program, that's the ICBM modernization, and also higher volume for military ammunition. Demand there seems strong.
And the profitability in defense systems?
Even better. Operating income jumped a healthy 15%. And the margin rate improved nicely to 9.9%.
Nearly 10%. Why the improvement?
A combination of factors, really. Right. Higher volume helps absorption, better performance on some programs, and also some favorable EAC adjustments.
Those estimates completion adjustments, fine-tuning profit on contracts.
Yeah, exactly. Looking ahead for defense systems in 2025, they're actually guiding for double-digit organic sales growth.
Double-digit? That's strong.
Yeah, driven by things like IBCS, Sentinel continuing to ramp, and their wider weapons portfolio. They also mentioned a successful static fire test for a Sentinel Stage 1 rocket motor. Big milestone.
Good progress there. Okay, what about mission systems? You mentioned IBCS growth there, too.
Yes, mission system sales were also up $148 million, which is a 6% increase. Growth across various programs there.
So top line good. Margins?
Margins in mission systems actually decreased a bit, down 4%.
Oh. Why was that?
A couple of things mentioned. Lower volume on some specific fixed price programs, which can hurt margins. And also they're making investments in pursuing some restricted, likely classified new business opportunities.
Investing for future growth, potentially.
Yeah, right. That dip was partially offset by some positive EAC adjustments, similar to defense. For the full year 2025, they're expecting mid-single-digit growth in mission systems.
The margins should recover. They expect margin improvement in the second half of the year as programs ramp up and they get some cost efficiencies going.
You mentioned IBCS earlier. Any news there?
Big news, actually. They got awarded a nearly $500 million contract to expand IBCS capabilities. That's the Integrated Battle Command System.
Right, the system that connects different air and missile defense sensors and shooters.
Exactly. This contract focuses on software enhancements, AI integration, model-based systems engineering, really pushing the tech forward.
And they're building capacity, too.
Yes, they opened a new production facility down in Alabama, specifically for air and missile defense systems, including components for IBCS.
Okay, busy segment. Now, aeronautics. That's where B-21 lives, right? How did that segment do overall?
Right. Well, as you'd expect, given the B-21 discussion, aeronautics sales were down 8% year over year in Q1.
Primarily because of that lower B-21 volume recognition.
Primarily that, yes.
Yeah.
Also some timing issues on more mature programs, including the F-35 fighter jet deliveries.
Okay. And the margin impact from the B-21 adjustment hit this segment's outlook.
Correct. They updated their expected operating margin rate for aeronautics for the full year down to the low to mid 6% range because of that charge.
But they still expect growth for the full year.
Yes. Despite the Q1 dip in the margin adjustment, they're still forecasting mid-single-digit sales growth for aeronautics for the full year.
Interesting. Okay, last segment, space. How did things look there?
Space also saw lower sales in Q1. They said this was due to a previously communicated sort of planned work window slowdown on two specific programs.
Okay, so expected softness?
Expected, yeah. And also just lower volume on some other satellite programs compared to last year.
But margins?
Interestingly, despite the lower sales, Space actually had improved program performance, which led to a higher operating margin rate of 11%.
11%? That's quite good for space.
It is. For the full year, they're forecasting roughly $11 billion in sales for the space segment.
Any key wins or updates in space?
Yeah, they highlighted receiving nearly $300 million in Navy awards for 2 additional Triton surveillance aircraft and associated support.
The high-altitude drone, right?
That's the one. And they noted progress on delivering Tritons to Australia, with deployments expected to start soon from southern Japan.
Okay, so a lot happening across the different business units. What's the bigger picture, the overall market outlook, and the main themes they emphasized?
Well, the big theme is strong underlying demand, right? That record backlog really underscores it. Customers globally seem to want what they're selling.
Even with those Q1 contract delays you mentioned?
Yes, they acknowledge those delays hit Q1 sales, but they expect the award environment to improve as the year progresses.
And the U.S. budget situation looks more settled now.
More settled, yeah. They sounded pretty optimistic about U.S. defense spending. The FY25 budget is finalized now, includes a top-line increase and more spending flexibility, plus potential for additional funding later.
And looking even further ahead, FY26.
The administration's FY26 budget request signals continued focus on key national security priorities. The nuclear triad, missile defense, advanced weapons, all areas where this company is, heavily involved.
So U.S. demand looks solid. What about internationally? You mentioned strong bookings.
Huge emphasis there. They talked about a significant increase in defense investment happening outside the U.S. It's creating a really growing international pipeline for them.
The numbers back that up.
Absolutely. International sales were up 11% just in Q1, and their international book-to-bill ratio, new orders versus sales, was a very strong 1.45.
Meaning they're booking international orders much faster than they're currently selling internationally.
Exactly. That points to future growth.
Yeah.
They highlighted Poland, for instance, signing a big $745 million letter of acceptance for AARGM-ER missiles.
So specific examples of big international wins.
Right. And they see a broad pipeline globally, especially in air and missile defense, airborne ISR and command and control systems, and ammunition, too.
Sounds like they're positioning themselves for this demand, investing internally.
Definitely. They pointed out they've invested $13.5 billion just over the last 5 years in R&D and infrastructure. That's huge.
What's the goal of that investment?
To scale up both design and production capabilities. They're also leveraging their internal tech, hardware and software, and partnering in areas like artificial intelligence to develop next-gen systems.
What about supply chain risks? Any concerns there, especially with trade policies?
They mentioned that about 95% of their supply chain is actually domestic, sourced within the U.S.
Oh, interesting. That helps mitigate some risk.
It does. They said they're watching evolving trade policies, of course, but currently don't see any significant risk there. One other housekeeping note, the divestiture of their training services business is still on track.
When's that expected to close?
Should close mid-year, probably early Q3 for modeling purposes.
Okay. And the overall sales cadence for the rest of the year?
They expect sequential sales growth in Q2, so higher than Q1, and then a stronger ramp, a more significant step up in the second half of the year.
Driven by?
Driven by some of those big contract awards from late 2024 starting to convert to sales. Things like TACO, IBCS, international radar programs, plus just the timing of getting parts from subs and materials and landing new program awards.
Okay, so summing it all up, if you're an investor looking at this, what are the key takeaways? How do you balance the B-21 news with everything else?
Well, I think the D-21 adjustment, yeah, it's substantial, but it does provide updated clarity, right?
Yeah.
It reflects what they've learned getting these first planes built.
And the process changes are meant to be beneficial long-term.
That's the argument. To reduce future production risks and potentially enable higher build rates later, which could match future demand if it increases, that's the potential upside.
And offsetting that near-term hit.
You have that really strong backlog and the clear growth in international business. It shows sustained demand across the portfolio, which helps buffer things.
Plus the favorable defense spending environment?
Exactly. The outlook for spending in the U.S. and globally seems positive, creating a good backdrop for future growth. And progress on key programs like Sentinel, IBCS, plus those international wins, shows they're aligned with what customers want.
And they're investing in the future tech.
Right. That focus on R&D and innovation is key to staying competitive long term.
All right, perfect summary. Now let's shift gears to our favorite segment where we brainstorm some, shall we say, creative ideas. This is not financial advice part of our deep dive.
Always with that important disclaimer.
Absolutely. Okay, idea number one. We've talked a lot about the strong international bookings, right? And specifically mentioned Poland buying those AARGM-ER missiles.
Yeah, a concrete example of that trend.
So here's an outrageous but plausible trade idea for you. Given those clear signals of rising European defense spending fueled by geopolitics, what about considering a long position in a broad European defense ETF?
Ah, interesting. Not just this company, but the whole regional sector.
Exactly. It's a way to play that macro trend. The call highlighted rising European defense budgets rather than betting solely on this one company's execution. It leverages the theme beyond just this specific earnings report.
Okay, I like that. Thinking bigger picture. What's idea number 2?
Idea number 2 focuses back on the B-21. They talked about potentially increasing the production rate beyond the current plans, right?
Yeah.
And incorporating those manufacturing learnings.
Yeah, hinting at potential upside in build volume down the line.
So consider this as a paired trade. Go along a supplier company that's really critical for advanced materials used in stealth aircraft, maybe specialized composites, coatings, that kind of thing.
Okay, a key enabler for next-gen platforms.
Exactly. And pair that by going short a more traditional legacy aerospace component maker, someone less exposed to these cutting-edge next-generation programs like B-21.
So betting on a shift within the defense industrial base towards the newer, more complex technologies.
Precisely. It's a play on defense spending priorities, potentially shifting towards programs like B-21 and away from some older systems, reflecting the increasing complexity highlighted by that manufacturing discussion.
Got it. 2 interesting thought experiments there.
And remember, everyone, these are purely hypothetical ideas. Brainstorming, not recommendations.
Absolutely not financial advice. Always do your own thorough research before making any investment decisions.
Okay, that pretty much brings us to the end of our deep dive into this latest earnings call. We've really tried to unpack the key results.
Yeah, we looked at the financials, dug into that B-21 adjustment, explored how the different segments performed.
And put it all in the context of the broader market and guidance themes.
I think the takeaway is that the record backlog and that international momentum suggest a pretty solid foundation,
Yeah, but that B-21 program, both the costs and the production ramp, that's definitely going to remain a key area everyone's watching.
No doubt about it. It'll be interesting to see how that progresses.
So what are your thoughts? We'd love to hear from you. What do you make of the long-term implications of these B-21 adjustments? How do you see the global threat landscape continuing to shape defense spending, especially internationally?
Yeah, join the conversation. Let us know what stood out to you from our discussion today.
And one last time for the people in the back. The trade ideas we kicked around. Purely speculative, informational only.
Not financial advice.
Yeah.
Please do your own homework.
Thanks so much for tuning in to Talk Tickers. We appreciate you listening.
We'll be back soon with another earnings deep dive to keep you informed.